Hi there. This is Bob Graham with Riggs Asset Management Company. Today I want to do a kind of review of the markets, where we've been, where we're going, and try to answer some of the questions we've been getting from clients as we move forward through the rest of 2026. Let's start off by just simply saying, whether you're looking at your bond portfolios, your equity portfolios, the Riggs family accounts continue to do well in what's been a choppy market. So let's talk about what we're seeing and what our expectations are. First, to the bond market. When we look at the bond market right now, there's really a tug of war going on. If you turn on the financial news, there's should the Federal Reserve raise rates? Should the Federal Reserve cut rates? Should the Federal Reserve keep rates where they are? And the reason you're hearing that is because, A, you've got a new chairman, and people always like to ask these questions and kind of push a new chairman with their own thoughts. But the other thing is, we're seeing different things in the economy. So let's talk about the employment background first off. When we look at employment, really going back to 2021, coming out of the pandemic, there's a huge amount of hiring just in case. Making sure you had enough employees to meet the demands you had. And since that time period, and we'll put a chart up here, and you can see that we've basically seen the employment levels trending down. And this has been obviously, call it a 5-6 year trend. And lately, employment's been flattish, I'll call it. So you're really not seeing inflation come out of the employment numbers. And what you typically look for there is something called wage push inflation. And that's driven when there are more jobs than there are people. And right now what we're seeing is, if anything, the employment market is flat to slightly soft. So there's really no inflation push on the employment side of the equation. So where are we seeing inflation or prices moving higher? And that's really in the commodity space. Right now, turn on TV, everyone talks about oil. Oil's up, oil's down. Talk about Brent. Talk about West Texas Intermediate, and that is an issue. By the way, interesting enough, not that it helps for right now, but when you look at the development of the oil fields in Central and South America, some of the oil fields we're seeing in parts of Africa and other parts of the world, it's likely that whatever comes out of the Strait of Hormuz is going to be replaced by something else. So we could actually see down the road, obviously a year, 2 years from now, oil prices substantially cheaper. Having said that, we are seeing commodity demand increase. We're seeing it in copper, we're seeing it in tin, seeing it in aluminum, we're seeing it in rare earth metals. Anything you need to build a factory, an industrial plant, a data center, an electrical grid. Anything that goes into that is in very, very high demand, not just here in the United States, but across the globe. And so we are seeing price rises in that area. So basically, stuff that comes out of the ground. So you've got employment kind of easing down on inflation. You've got commodity prices pushing up a little bit on inflation. Maybe we're about in balance. So when we take all that data and we look at the bond market, what we see is something that, at least right now, unless something changes, is probably going to largely trade sideways. Whether the Federal Reserve increases interest rates a little bit, probably not going to cut them, keeps them the same, really is not going to matter that much to what's driving the economy. So on the bond side, our bond portfolios are doing well, but we've really optimized those to capture as much coupon as we can right now with as little risk as possible. So I think when you're looking at the bond market, at least the way I think about it is, it's the coupon that you're going to receive is the money you're going to receive. And there's probably, at least right now, not too much beyond that. Having said that, a stable bond market is a decent environment for an overall economy. So let's talk about the economy and what's driving the stock market and where we are today. In order to go there, let's really think about historical trends. And we've said this before. When we look at the stock market, it has been largely following a typical or historical midterm election year cycle. And that is decent start to the year, a pullback in the spring, typically a strong summer. Quite frankly, June and July were choppy. But we're seeing a pickup in August, largely driven by earnings. As we move forward, we expect a pullback in the fall. September, October, we should see the markets pull back as we come into the election. Once we have the election, everyone will go, okay, we now know what's going to happen to Congress, know what's going to happen to the Senate, and they will largely move on. And then we have a strong year-end rally in a typical midterm election year. And that's pretty much what we've been following, maybe a little bit more volatility than historically norm, but that's pretty much the process. So the way I think about this is, just like we talked about last year, 2 steps forward, 1 step back, 2 steps forward. That's where we think we are. But let's talk about what's driving, because there actually is a change in the markets and what's driving the markets. And that's earnings. And we're seeing that across the board. We've talked about in the past, we've talked about logistics companies, trucking companies, railroads, airlines, shippers. They're all doing really well. This is really the blood of an economy. And what you see right now is that organization doing well. We're seeing retail is doing well. Industrials are doing well. Manufacturing is doing well. Construction, maybe not so much on the housing side, but certainly if you're a construction company and you're adaptable, you're more than making up for data centers and reshoring of factories. So when we look at the economy, we're really seeing things hum along. To put that in perspective, right now, we're about 2/3 or more through this earnings cycle for the second quarter of 2026. Right now, excluding special profit events, just operating earnings, we are seeing margins coming in at 28%. That's phenomenal. These are margins we've not seen ever before in history. So companies across the board, like I said, logistics companies, manufacturing companies, technology companies, are all seeing terrific profit margins. Part of that is demand. Part of that is the fact that U.S. corporations are run really, really well, and management does a pretty good job of managing that company. So how is that being reflected in the market? So if you look at smaller companies as measured by the S&P 500 small cap index, or mid cap companies, ones that aren't small but aren't big, so I'm going to the S&P, and then the large cap. We're seeing all of those indices moving up and to the right and hitting new highs. The S&P 500, you see the number of companies above their 200-day is north of 70%, above 50-day, 20-day, very close to 70%. Again, that means most companies are moving higher, and what's driving it is profits and margin. We are seeing the best profits and margins of companies in the U.S. economy that we've seen in history. So let's talk about market valuation. And by the way, I'm going to get a little wonky, but stick with me for just a few seconds here. So basically what we did is we went back and said, profit margins today, or not look back, but we looked at profit margins and go, profit margins today are higher than they've ever been in the history of the U.S. stock market. But how does that compare relative to the value of the market and historically how it's played out? So we went back to 1990 and we said, let's take the profit margin of the S&P 500 as it has been constructed over those years, 1990 today, and what is that profit margin relative to the forward PE, that's the forward price to earnings ratio of the market. What companies say, what analysts say, what the expectations are for earnings as we move over the next quarter, 2 quarters, 3 quarters, etc. And essentially what we found out is that even though the price to earnings ratio of the market may be higher than it has been in past markets, the margins and the profits are so good that the valuation, that is to say, the relative valuation of price to earnings to profit margin, is actually lower today than all but 3 years over the last 37-year history. And those 3 years were 2011, 2012, coming out of the Great Recession, 2018, where we had a Federal Reserve misstep and basically drove down market valuations because they rose rates too aggressively. So basically, when we're looking at the market today, and I'm not saying it's cheap, what I am saying, if you compare profits, if you compare margins and valuations, today is cheaper than all but 3 years over the past 37 years. Quite frankly, that's a pretty good time to be looking at markets and companies with growing earnings. So what does it tell us? It tells us that companies are profitable, they're doing well, they're executing, and we have an economy that's humming along. Now, does that mean we're not going to see pullbacks? Of course not. Our expectation is we have a pullback in the fall, going into election, strong year end. By the way, we're very optimistic about 2027. So wrapping everything up, portfolios are doing well. We're well structured for the market we're in today. And when we look at US companies and we look going forward, the market's not expensive relative to the growth and the earnings drivers that we're seeing out there. In fact, the market is arguably cheaper today than it was in 1990, 98, 2006, cheaper today than it was 2024. So we see a pretty good market in front of us. Again, 2 steps forward, 1 step back, but you're positioned to take advantage of this environment. Anyway, if you have questions about this video or anything else, reach out to your Rakes team member. We're here to help you in any way we can. Thank you very much.